From 2015 to 2019, EPF returned an average of 6.84%, putting it in the top quartile of these funds in terms of performance. Secondly, how many people are willing to manage money for you for free? Think about it. While putting money into a bank account is free, don't forget all those tiny fees that the bank charges you. ATM card fees, bank account opening fees. I don't remember EPF charging me anything. While most leading stock indices were down during the COVID-19 pandemic, EPF managed to rebalance their portfolio by writing down 7.71 billion of its listed portfolio and take profit of some of its positions in Q4 2020. Hi everyone and welcome back to our channel, the best place for long-term stock investors. My name is John and in this video you're going to learn about the Malaysian Employees Provident Fund, or EPF for short. Sorry guys, no ticker symbol this week. In this video, I'll share with you that EPF is the best ETF you can invest in. I wanted to produce this video after my first withdrawal experience from EPF directly into my account. Prior to this, I have to admit I hardly bothered to dig deeper into the mechanics of EPF and how it invests. To see if EPF is really for you, stay till the end to find out. So before we dive into the mechanics of EPF and what to do about it, I'll just go through a bit of history about EPF and why was it set up. It's actually one of the oldest pension funds in the world, set up in 1951. Yes, before our nation's independence, under the EPF Ordinance 1951. It was placed under the jurisdiction of the National Directors of Posts, you know, the post office kind of post. By 1952, it had approximately 500,000 members and 2.6 million in contribution. In 1991, the EPF Act of 1951 was replaced by the EPF Act of 1991, which governs it till this day. It has a very important section called Section 27, which I'll discuss later in the video. Today, it has 14.59 million members and a total investment assets of 998 billion as of December 2020. The EPF scheme was set up as a social securities organization to provide retirement benefits for the private sector and pensionable employees in Malaysia. The EPF Act of 1991 requires employees and their employers to contribute towards their retirement savings and allows workers to withdraw these savings at retirement or any other special purposes before that. Every year, EPF will declare an annual dividend of funds deposited based on their investment returns of the total fund. Since 1952 till today, it has returned a simple average of 5.94%, with the highest being 8.5% in 1993 till 1987, the golden years of the Malaysian economy. How do they make those investments to pay the dividends each year? It allocates contribution to different asset classes to gain investment returns on both short-term and long-term durations. As of the year ending 2020, their biggest allocation is fixed income instruments at 46%, followed by equities at 42%, money market instruments at 7%, and finally real estate and infrastructure at 5%. However, their biggest percentage of income came from their equities portfolio, even though it is only the second largest allocation. While most leading stock indices were down during the COVID-19 pandemic, EPF managed to rebalance their portfolio by writing down 7.71 billion of its listed portfolio and take profit of some of its positions in Q4 2020. Are you confused and struggling to invest profitably in the stock market? Don't know where or how to start and is overwhelmed with all the information you find online? If you really want to level up your investment game, then give us 2 hours of your time to let us show you the mistakes we've made and the systems we've created with our combined investing experience of 20 years. And in case if you're wondering, yes, it's free. The only thing we ask in return is your full attention and your desire to be better than where you are today. As they say, a parachute is only useful when it's open. Don't waste your time attending if you already think you know everything. The registration link is in the comment section below. Next, we look at how EPF fares against other pension funds around the world. According to a report by Thinking Ahead Institute, on the top 20 pension funds around the world, Malaysia's EPF is number 12 with an asset size of $226.1 billion as of December 2019. The average compounding growth rate returns of these top 20 pension funds are between 5.5 to 5.8% over the past 5 years. From 2015 to 2019, EPF returned an average of 6.84%, putting it in the top quartile of these funds in terms of performance. The number one pension fund based on asset under management is the Government Pension Investment Fund of Japan, with a total asset size of $1.55 trillion. Its 10-year annualized returns are 3.37% from financial year 2001 till financial year 2020. Now, I would take that as a Japanese because their bonds are yielding negative yields right now. The second largest was the Government Pension Fund of Norway, which returned 6.29% annualized returns since inception in 1998. So kudos to those in the investment team at EPF. The performance of the fund is on par with the biggest pension funds around the world. Next, we dive a little deeper into the portfolio of EPF. As mentioned earlier, the biggest allocation in the EPF portfolio are fixed income securities, and some of these come in the form of Malaysian Government Securities, or MGS for short. MGS is a coupon-bearing, long-term bond issued by the Government of Malaysia to raise funds for development expenditure. In short, these MGS purchasers become the bank and lend money to the government in exchange for an interest rate or interest payment, which is called a coupon rate. The coupon rate for a 5-year MGS is about 3.95% today. EPF also invests in foreign fixed income securities and is not just limited to the Malaysian debt market. The reason why EPF has such a high or big allocation in fixed income securities is because its primary objective is to pay annual income in the form of dividends to shareholders. Equities, while able to give capital appreciation to the portfolio, will not be able to give consistent payouts like fixed income securities. The equities portfolio is quite well diversified too, with holdings both domestically and abroad. In 2019, the biggest exchange invested was still Bursa Malaysia at a fair value of 136 billion, with investments also spread out to the New York Stock Exchange and even the Indonesian Stock Exchange. Next is their money market instrument allocation. This is meant to be a short-term parking space for members' withdrawal that happens year in, year out. An example of the use of these money market instruments was the iSINA program, which warranted EPF to increase its money market holdings in anticipation of these huge amounts of withdrawals, to the tune of almost 130 billion ringgit. Last but not least, their real estate holdings also spread across the globe, from 20% holdings of the iconic Battersea project in the UK to Yarra Park City in Australia, and closer to home, Kuasa Damansara. As you can see, when you're invested into EPF, you're really getting a global portfolio of stocks, fixed income instruments, money market, and real estate. You're investing in a global ETF instead of just the KLCI or the S&P 500 index, plus all these other instruments to boot. Our objective for starting this channel has always been to upskill investors and create a like-minded community so that they are able to invest their money better. We do this by creating concise but well-researched content. If you have benefited from watching this, do help me smash that like button so that this content can benefit a wider audience. And if you're new to our channel, remember to subscribe and hit that notification bell so you know when the next videos are out. So here comes the biggest question that most people ask, especially in today's gig economy. It is whether they should contribute to EPF or invest on their own. Well, let me list out the pros and cons to help you decide if it is for you or if it's not. Among the advantages of contributing to EPF are these. For me, the biggest advantage of the EPF system is actually a forced savings for those who struggle to invest. Remember the phrase, pay yourself first? Ask yourself, how many actually do that, especially when your lifestyle spending is more than what you earn? In this case, you don't even have an ATM card to withdraw money from EPF. Secondly, how many people are willing to manage money for you for free? Think about it. While putting money into a bank account is free, don't forget all those tiny fees that the bank charges you. ATM card fees, bank account opening fees. I don't remember EPF charging me anything. Thirdly, under Section 2.7 of the EPF Act 1991, the guaranteed minimum dividend rate is 2.5% per year on members' savings. As such, members are actually guaranteed to receive the minimum dividend rate in any situation. Even then, EPF has consistently been outperforming these rates and delivered superior dividend rates to the contributors of above 5%, while even in economic dire situations. While it may not be a guarantee for future performance, it does give them credibility on the way the fund is managed. Next is actually the fees. Now, there are some who invest their money into mutual funds instead of EPF as they don't want their money to be locked in until they retire. So how do you benchmark your costs to returns of your money between EPF or unit trust? Mutual funds normally charge you on two things. First is a sales charge, which ranges from 1 to 5.5% of the amount invested. The second thing they charge you on is the asset under management fee or AUM fees. This is sometimes known as a management expense ratio or MER. This is usually between 1 to 2% of the fund size, and it is to cover the cost of running the fund, like paying the fund manager and day-to-day operations. EPF does have a cost of running their funds. Hey, their employees need to be paid as well, okay? So over the past 5 years, their total expenditure over total assets is roughly between 0.16 to 0.18%. This is a comparable rate to a passively managed ETF fund expense ratio. I can assure you EPF is far from passive, but that's a story for another day. Here's an example of how you should measure a unit trust performance against EPF. If EPF is giving you 5.2% dividend, minus the expense ratio of 0.18, you get roughly about 5% dividend returns. A unit trust fund has to perform at least 9.5% to match that of EPF. 9.5% minus sales charge of 3% minus 1.5% of AUM fees. There you go, that's how you should compare it. Next benefit is actually more for employees. As an employee, you are mandated to contribute 9% of your monthly income, and your employer is mandated to contribute 13% or 12% if your salary is above 5,000 ringgit. While technically it is not free money, what other systems have a matching contribution from your employer for your retirement planning in Malaysia? One more benefit is actually from an estate planning perspective. On top of the bereavement and funeral expenses benefit that EPF gives, EPF monies distributed to beneficiaries are actually creditor proof. What do I mean by that? If there's outstanding debts by the account holder, the creditors cannot forcibly withdraw the EPF payout to settle the debt. Unlike other assets like monies in your bank account or even your touch and go balance. There's a lot more advantages, but I'll end with this one. If you are a non-high net worth Malaysian, how can you get access to a private equity fund manager? Well, as an EPF contributor, you do now. In a press release on the 26th of February 2021, which is almost hot off the press at the time of this recording, EPF has just launched their Sharia Private Equity Fund Direct and Co-Investment Managed Account, or SMA, with an allocation of $600 million. The three private equity managers, BlackRock, HarbourVest Partners, and Partners Group AG, will be given $200 million each and a global mandate to invest. That means these managers can scour the globe to invest even in private entities and not even public ones to get the best returns possible for EPF. I'm impressed. By the way, I can assure you that EPF doesn't pay me to promote them. Okay, now, the gloomy part. What are some of the risks that you have to consider if you're going to contribute to EPF? Well, for starters, you cannot withdraw your money before you hit the age of 55, which is retirement. The second scenario is in which you're dead, in which the money isn't yours either, it belongs to your beneficiaries. And last but not least, if you immigrate overseas. Now, there are other reasons you can partially withdraw your money, like your first property purchase, a medical emergency, or unit trust investments, or if you have excess of 1 million in your EPF. But what I've mentioned earlier was a full withdrawal. Secondly, you have no control of your EPF investment decisions. Well, most don't even care, I believe, as long as there's dividends at the end of the year. Thirdly, should EPF changes its policies, for example, the introduction of tiered dividends to help smaller account contributors, you are in no position to withdraw or to protest. Last but not least is the risk of the Malaysian government going belly up or bankrupt. Well, it wouldn't be the first time a government actually bankrupts, as evident in what you saw in Greece. Remember MGS holdings in EPF that I mentioned earlier? Well, those are all government bonds. So there you have it, the risks that you have to consider if you were to invest in the EPF. Thanks for staying till the end, and do watch some of our other videos on this channel. I do want to give a shout out to Hafiz at the EPF PJ branch for helping me explain the prorated dividend calculation. Follow us on Facebook and Instagram with the links below. See you in the next video.